Right. But if they come in 5 years later, if they retire and the first few years are bad and they're not working with anybody like us, they're just holding on and cutting back. What I find is that it's very, very hard, even if we secure the plan and get them out of this risk of running out, they have a hard time ever flipping the switch and being able to enjoy retirement in the same way. That first few years creates the mindset for the entire retirement. And if you leave that up to how the S&P is going to do over a 3-year period, there's risk there beyond how much money am I going to have when I die. There's risk in am I going to have the retirement I want? You're not really basing that on a 30-year average. You're kind of rolling the dice and saying these next 2 years are going to determine my next 30.
All right. Good morning. Morning, Jake. How are you doing today?
Good morning. Doing fine.
Yeah. We've got an interesting month or so in the market here. It's been a little bit crazy. Now, as of today, it's up just a little bit. But it was down yesterday, down the day before, and down for the month overall. So that's what we're talking about today, kind of how retirees are thinking about it, what we're doing to strategize around it, kind of how our strategies work with volatile markets like this.
It matters when they're approaching retirement, but a lot of times they're not looking at their individual 401k allocations and saying, this company's down, it's hurting my retirement. This company's up, it's doing great. They just have a fund. It's a target date fund. It's up or down. They check every 2 weeks when they get paid. And that's the only time they check it. As they get a little bit closer, they check it about every 10 minutes. It gets to be a little bit more of a worry. But once they're retired and, we get their plan built, they only check it if they want to. And right now they don't want to. So they just ignore it. Which is a great strategy.
Yeah. It's wonderful to be thinking about, you get calls from clients, and have you had anybody calling in asking about what's going on here? Or is it pretty much just, they're all comfortable with it?
Yeah. I had one text message that just said, if the market goes down 30%, does my income change? And I said, no. And they sent back a smiley face. That was the end of the conversation. So just very minimal worry. Of course, people don't like when the market's going down, but when it doesn't affect their day to day, they go, oh, the market's down. All right, well, I'm going on vacation. See you later. And
that's how we got there, because there are a lot of people watching this that aren't there, that are very nervous about what's going on. Maybe they haven't done some planning around it, or we need to kind of remind folks of how the plans protect against situations like this. Let's start with what's going on. And let's start with that so we can kind of get a baseline of what's happening in the market. Does that make sense? Do you want me to talk about it? You want to talk about it?
Yeah, go ahead and get into it a little bit, and then we'll talk about why it matters.
So we are at all-time highs in the market, or at least we were a few weeks ago at all-time highs in the market. All of the companies not all the companies, but the bulk of the companies that are making up S&P 500 and these big indexes, they've gone up so much. Last year they were up 23%. It's for the year, just huge returns, and that means they're valued very highly. And people are starting to get nervous about how high they're valued, about the valuations. And what they're wondering is if we can continue growing like this, if there's more room to grow, or if it's time for those prices to come back down to earth. When those valuations start coming back down to earth, that is when you start seeing the price drop, that your portfolio starts dropping as those valuations come down. Does that make sense so far?
Yeah. So, with everything at all-time highs, people, of course, they're not worried about 20, 30 years from now. They're worried about short term. What are your thoughts on maybe the next 2 or 3 years? Not to predict, but, just everybody, I think is fine in my age group waiting it out. But we're here talking about retirees, people who are getting closer. What are you thinking for the short term?
Yeah. So that's a great question, because the short term, our outlook is for volatility. That is, we think about how certain. So the market does not like uncertainty. The market likes knowing what the rates are going to be, what the policies are going to be, all of these, these economic indicators that are moving in a steady direction. When things are steady and sure, then the market kind of knows how to invest. But if they're not sure what the policies are going to be, and if they're not sure what taxes are going to be, and if they're, companies are going to be taxed differently, if imports are being taxed and tariffed and those things, there's some uncertainty there. They just don't know how to invest. So a lot of times they pull back and say they're going to wait on the sidelines until they figure that out. So that's why you see this volatility. Short-term volatility just means that the market is going to go up, it's going to go down. It's going to be a bumpy ride up and down until they get some type of stability that they know, okay, this is what's happening. So this is how we can invest. So that's our short.
Right. So, and for our clients, just the way they talk about it, I know when things are volatile, on the day it goes down, they want to pull out of the market. And then when the market comes back up, they're not in it yet. Do you see that pretty often, that people maybe overreact a little bit? Is there something they should be doing while it's volatile? How should they be react?
So that's a great question. Someone may say, you hear me say, we're looking for some bumpiness for the next few months here. And they say, well, why don't we just get out of the market? If it's going to be bumpy, why don't we just sit on the sidelines? I can get 4% in cash. Why don't I just do that? And the reason is, we don't know what's going to happen over the next few months. It may skyrocket for the next few months. There may be some catalyst and it just goes up 10%. And then we're sitting on the sidelines in cash, and we just completely miss out on that. Matter of fact, JP Morgan has a slide on this. I'll show you here. Let's see. This is their guide to retirement. And they have a slide on impact of being out of the market. So what we're looking at here is we're putting $10,000 in the S&P 500 and watching what it does from January 2005 to the end of 2024. Okay, so what does your money do? What does $10,000 do over this 20-year time period, right? So there are good days, there are bad days, there are best days and worst days, those kind of things. And 7 out of 10 of those best days occurred within 2 weeks of the worst 10 days. So if there's a terrible day, it goes down 2%, 2.5%, 3% in a single day. A lot of times, 7 out of 10 of the best days, we're going to go up 2%, we're going to go up 3%, we're going to go up 1.5%. That occurred within 2 weeks of those worst days. So the problem is we get out of the market, like the market goes down, we move all to cash, and then we miss it when the market goes back up. And then we jump back in as it's gone back up, and it goes back down again. And so we're losing here. We missed the upside, and then we're just going back in and getting that downside every time. So if you missed, if you were fully invested for 20 years, for $10,000 in the S&P 500 20 years ago, that $10,000 would grow to $71,750 here. Okay, you see that right here? And if you missed 10 of those best days out of 5,000 days, right? Is that right? 5,000.
More than that. 20 years.
Yeah, 20 years of 200. Yeah, it's about 5,000 days or so. 5,000 days of the market's open, right?
Got it.
If you list just 10 of those best days, have $32,000 instead of $71,000. I mean, our clients don't have $10,000 in the market. They have $1 million in the market. We're talking about them going from $1 million over 20 years. Do you see this? I mean, these multiples are just huge. We're talking about $7 million instead of $3 million.
40% difference just for being 1 day late every 2 years.
Right. Exactly. Missing 1 day every couple of years. So how do we, so that's why we don't want to jump out, because I don't know when the best days are going to come. I don't know when the good days in the short term, you don't know when they're going to. So that's why we don't want to move out for short-term volatility, because it could be great over the next few months and we miss out on that. And then we jump in, we say, oh, it's great now. We jump in and then we see it drop.
Mm-hmm. And if they're just completely uncomfortable, maybe there's something else you can do as far as not leaving, but maybe, having a different amount at risk. You can secure yourself without completely leaving the market because you're worried? Is there something else
Yeah.
people can do if
Yeah.
they're
That's
just
when
not sleeping at night?
yeah. So we have to think strategically, right? We got to think about the strategy for being in the market, not just, timing, should I be in or should I be out? But how can I win and feel confident in winning when I don't know the short term? The, the bad news is it's very, very difficult to impossible to say what's going to happen in the market in the short term. Your guess is as good as mine. I mean, and everybody that talks about it, they're just guessing, they're just, oh, I think it's going to be up. It's a guess. It's a gut feel, And so trying to figure out what it's going to do in the short term is just a losing game. But the good news is you can know with some confidence what it's going to do in the long term. That is, when you're investing in the S&P 500, you're investing in 500 of America's best companies, right? While one of those is going to go out of business, a few of those may go out of business long term. That is 10 years down the road. I laugh when I say long term because our clients are retired and they all laugh and they say, Sam, long term, I'm going to be dead. What are you talking about? What are you talking about long term?
Right.
I mean, 10
So there's
years.
two groups. Some of them say they're going to live forever, and then some of them say they've got about 1 year left in them. So there's two groups.
Right. But when I say long term, I don't mean 40 years long term. I mean 10 years, right? So if you're 60, I'm talking about what the market's going to be at when you're 70. If you're 70, what's it going to be at when you're 80, right? We have a lot more confidence that 10 years from now, American companies will be valued higher, they'll be stronger, they'll be better, worth more, and therefore your investment will grow 10 years from now rather than today. So we don't have some type of long-term gloomy outlook on America where we think, it's the best it's going to be in 10 years from now, 15 years from now, America is going to be worse than it is today. No, long-term, we feel confident that it'll grow. So that's a really important strategic marker though, right? I mean, think about it. If you don't know what's going to happen in the short term, but you have a lot of confidence that 10 years from now, it's going to be higher than it is today, then you can use that to create your strategy, right?
Of course, because when people come in to me, let's say they're 60 years old, they're not willing to put travel and retirement on hold until the S&P comes around. They're not willing to spend less time with their grandkids because the market's volatile. So they want to participate in some of that long-term growth, but they don't want it to affect the way that they usually describe it is they want to be able to do what they want. And not just on days where the market's up, or not just in years where the market is not as volatile as it is right now. So they're not willing to work longer or give up the things that are most important to them just because the market's acting crazy.
Yeah. Yeah. And that's where this is really a danger. It's for people who, if you haven't planned for this, for short-term volatility and short-term losses, because the market can correct. We talked about the short-term volatility, the next few months. We talked about long-term, like 10 years. But what about between here and there? Like that midterm kind of thing. What about 3 years and 4 years? What is that?
And
And
we're talking about averaging a lot right now, but what I think we need to get into a little bit is where averaging can kind of lead you astray when you're looking at average returns over a 10-year period versus the way that it may actually play out and how that can affect your retirement.
yeah, yeah, that's really it. Because if you are going to be using your money within the next 10 years, like if there are strategies where we can say, let's invest differently for different money, right? Let's have money that you want to grow for late retirement, for mid-retirement. I'm going to need an inflation boost 10 years from now. I'm going to need money for healthcare 10 or 15 years from now, those kind of things. Then we can invest that for what we think it's going to return in 10 years when you need it. But what about people who need the money today? That's really the danger, because it very well could be that we see a recession. It could be that we see a downturn that takes a few years to come back from. Yeah, let's talk about that a little bit. I've got a good slide here to show, and this is what I sent an email out to clients saying that we were going to cover this slide. So let's look at this one here. This is sequence of return risk. This is what I'm concerned about, and what we get concerned about with people who haven't done planning yet and who are getting close to retirement. So this is for people who feel like you're going to start taking income from your investments in the next 3 years, 4 years, 5 years, or you just started taking it just in the past few years, right? These are people just on a few years either side of retirement. This is what we're concerned about right now. Do you want to explain this chart? Or do you want me to?
Yeah, sure. So the using that top chart there with the purple line going up, that's somebody who retired and the first few years in the market were great. They started taking money out. They probably didn't even notice a decline, or they definitely didn't even notice a decline in the asset value. They're living on the money and it's going up at the same time. Everything's great. The person in the middle, we're using just averaging, as assuming the same growth every year for 30 years in retirement. And you can see that it works. There's a little bit of decline over time, but they're probably pretty happy with how their plan is working, especially in those early years where they're spending and they have the same amount of money at the end of the year. But the person on the green line is doing the same thing as those other two examples, but their first few years are bad. Even though the average returns on all three are exactly the same, if you flip the returns, which is what you'll see on that bottom chart, if you look real closely, you can see those first 4 or 5 years on the purple chart are kind of up with a declining amount. Look at the end of the green chart and look backwards, and you'll notice they're just reversed. Same scenario, same average, same person, same amount of withdrawals. But if the bad years come early, by the end of year 22, they're completely out of money. And what I would say that would happen maybe in reality is nobody is going to withdraw themselves out of money if they can help it. What they do is let me take a step back. Our clients that come in are able to retire or consider retiring because they are savers. They didn't pass it on to their kids at all, but they're savers. They didn't go out to eat 5 days a week so they could retire. They didn't buy the fancy sports car so that they could buy it in retirement. And all those years that they were, driving the minivan instead of the pretty SUV, and all the years that they were saving money, they're getting to retirement and they're willing to make sacrifices for the future. They're still the same person that they were when they were 20, 30, 40, 50, saving for retirement. So the market goes down in the first few years and they're spending money. What actually happens is that they pull back as far as they can pull back. They live on the bare bones that they need to pay their bills, maybe see the grandkids once a year, and they sacrifice. And because you don't know if it's ever going to recover or how long it might take, they're not really even looking at the money. At that point, they're trying to hold on for dear life, and they're saying, I need to spend as little as possible, because their first impression of retirement is you could lose 20 or 30% of your money in a year. Well, they're going to do the simple math and say, if I spend like I want to, I could be out of money in 3 years, 4 years. And they will live a dramatically lower quality retirement than they could out of fear that is only based on how the first 2 or 3 years go.
Yeah.
So look, we can sit here and look at a 30-year retirement. They are looking at today.
Yeah, but they're right if they're taking money out of the market in order to get that income. They're absolutely right to say, I need to tamp my spending now. I need to reduce my spending.
But if they come in 5 years later, if they retire and the first few years are bad and they're not working with anybody like us, they're just holding on and cutting back. What I find is that it's very, very hard, even if we secure the plan and get them out of this risk of running out, they have a hard time ever flipping the switch and being able to enjoy retirement in the same way. That first few years creates the mindset for the entire retirement. And if you leave that up to how the S&P is going to do over a 3-year period, there's risk there beyond how much money am I going to have when I die. There's risk in am I going to have the retirement I want? You're not really, you're not really basing that on a 30-year average. You're kind of rolling the dice and saying these next 2 years are going to determine my next 30.
Yeah. Yeah. So you have somebody who they get close to retirement. They're looking at their IRAs and 401ks. They've got $1.3 million sitting there. They've done the math. They feel confident that that's going to be enough for them to retire. And then they're ready to retire next year. They come back next year and their IRA is at 800,000 instead of 1.3 or 1.2, whatever it is. And I mean, all of a sudden they're asking, should I wait to retire? Should I take less? Am I still
Should I go
able?
back to work?
Should I? Yeah.
Should we cancel our vacations for the next 2 years? Should we?
Yeah.
And the problem with all those questions is they're very reasonable, but there's no way to know how long they would have to do that.
Yeah. And so here's why it's reasonable. This chart, this sequence of return risk, just to emphasize that, the green line on the bottom had a couple bad years in the beginning, just a couple bad years. You see, it came back, and there's the bar lines on the bottom, the bar chart on the bottom. The green is each individual year's returns there, and so they had a year, it looks like about 20% down, and then a few percent, and then it came back. But because they were taking money out to spend, so this is someone who started with $1 million and they're spending 4%. So they're taking a $40,000 a year retirement income. They've got 30 grand from Social Security, another 20 from a spouse Social Security, and then 40,000 on top of that. So they got $90,000 of income total in retirement, right? Taking that $40,000 off of this when the market is down, that is what really hurts this. And it's just so hard to come back. It drops and then you're selling when it's low. The old adage of buy low and sell high. That is, you want to buy something when the price is low. You want to sell it when the price is high. It doesn't matter if it's a house or a car or stock or anything.
Right.
So if the market drops and you want to take income, $40,000 of income, the only way that you get that $40,000 of income is you sell your stocks or or whatever your positions when the market is lower. So you've taken the loss, you're selling into it. Now you have even less when the market comes back. It has to work even harder to come back up. So that's,
and if you go back to slide 28 for a minute for me, because there are a group of people who would say, I have no problem cutting back while the market's down. And it's not a bad thing to be able to do that. Again, that's the reason they can retire, is they have that in them to save and cut back and to not overspend, even when your neighbors are doing it and it's tempting. And they have the ability to say no to spending. The problem is that it's not always up to you. This slide here is about how, again, we were talking about averaging versus individual years. People know on average how much they spend in a year. But if you retire, 60% of retirees in the first 3 years of retirement are seeing a spending fluctuation of 20%. That's going to be an air conditioner died. That's going to be I had to fix my roof, or had to redo a bathroom, or something major that typically you don't know ahead of time. Here in Florida, once a week, somebody comes in with an 8-year-old roof and says, the insurance company told me I have to replace this. Well, they have to replace it whether the S&P is up or down. The insurance company does not say, wait until the market comes back to replace your roof. So even for people who are willing to make cuts and able to make cuts, there can still be things that happen to you that cause your spending to spike at the worst time possible. And some of them can be put off. You can patch together a car with some repairs for an extra 2 or 3 years, but you can't patch together your roof, and you have to have AC. I mean, at least here, in Florida, AC is not an optional expense. I'm paying the Saturday rate, the Sunday rate, whatever it takes. It's going to come back on as fast as possible.
Yeah, and you can't wait on the roof either. The insurance companies are making people replace them.
Right. Yeah. And if the market takes 2 years to come back, which would be a quick recovery, you can't go 2 years without insurance on your home or without air conditioning. And And even for people who look at our first chart and say, cutting back's no problem. I've been doing it my whole life. We'll do it for 3 years. I'll work another 3 years, no problem. In those years, if you have spending that's out of your control, it's not going to matter.
Yeah, that's true. So there are a few major problems with, people who are retiring in the next few years. Bottom line is, if there was a major downturn, if we saw the market drop 30%, 40% over the next couple of years, people who are retiring are at the greatest risk. They're those are outcomes we do not want any client having to deal with.
I don't want people looking at the ticker in the morning when they're deciding whether or not to book the cruise.
Right.
And while the retirees are people who are close to, they're absolutely at the most risk. There are some positives to the current situation that, they may not have had to pay attention to while they're working, but all of this volatility and some of the inflation keeping the interest rates high, it's not all bad. High interest rates are great for people entering retirement, people in retirement. It's very new that you can make money on safe assets. No one's been able to make money at the bank. Returns on fixed income products are dramatically better than they used to be, but only if you take advantage of them, and only if you do it before, something bad happens to your assets. And something that's hard for people to look at is, as you're approaching retirement, if your money went up 20 or 30%, for most people, that's not going to dramatically change how they want to spend it. It'd be nice. Maybe they pull one extra vacation out. But if it goes down the same 20 or 30%, it can have a real negative impact on the rest of their life.
What kind of impacts? So just summarize those impacts for us here.
So if you lose 20 or 30% of the money you saved right before you get to retirement, it doesn't necessarily mean you can't retire. I honestly don't see a lot of people that come in and just cannot retire. What it means is that the retirement's not going to be what you have pictured in your head, or what you had pictured when you were 40 and you thought about retiring and skiing every year, or seeing your grandkids whenever you wanted to, or your kids. I always say grandkid first. My parents flew down here last weekend and I saw them for about 20 minutes and they were with my kids the entire time. So it's about the difference between retirement
and the competition. The kids are too cute.
I'm not in competition. I'm fine. They don't even know. The kids don't even know when I leave. It's fine. The difference in a big drop before retirement is those extra things that you wanted to do in retirement. You have to do a lot fewer of them, or do them less. You have to do them less often, or not as nice, or maybe you can't do them at all. And there's real sacrifices that have to be made on the side of, you can only cut your bills down so low. You can call cable bill, you can call them every day. They're only going to take $10 off your bill every month. It's the difference in big vacation once a year, or no big vacations, or maybe every 4 or 5 years. And when you start talking about these timelines going from once a year to once every 5, you're talking about the difference between 30 great vacations or 20 great vacations and 3, 4. When people close their eyes, they think about retirement. They're not thinking about sitting at home, paying their bills, just not having to work.
Right.
And almost everyone that comes to my office can achieve that, whether the market goes up or down. They could pay their bills. They've set themselves up in a way where their monthly bills just aren't that high for most of them, right? Social Security probably takes care of 80% of it. But the things you want to do are the ones that have to go if you have a big market loss right before you retire. Just plainly, you just have less money to be able to do it.
Yeah. Yeah. And if they're not doing that, they're really putting the rest of their retirement at risk. If they just keep their spending the same, that's really where this slide.
And they won't do that. They won't do that. That's what a millennial would do. They would say, I'm going to close my eyes and do what I want. I'm still going to go to Chipotle. And a retiree, whatever generation they're calling that falls under, these are people who will adjust. But they're adjusting down, and they struggle to adjust it back up later. even if the math says that it would be okay to do that. They cut, and then they get used to that. And that's what their retirement turns out to be. If we fix it early, we can get them before they've decided that retirement is watching game shows in the recliner.
Right. Right. So there's the first few years of retirement really, they really set a baseline for how you live. The rest of it, you've seen that.
Absolutely. I've seen people who lost significant percentage of their assets right before retirement. They weren't even retired yet. They were going into retirement. They thought they had a certain amount of money. All of a sudden, 30, 40% of it is just not there. Seen them, unfortunately never turn it around. Never, even though they're okay and they're, the people I'm thinking of, they're personally fine. They could go do what they want to do. It scars them. They're always worried about something like that happening again. Even if they've taken steps to make it impossible for that to happen again, they can't. Just hurts. It hurts to work your whole life and then in the last year have 40% less than you had created for yourself. It hurts people in a way that stays on your mind for the rest of your life.
And the thing is, a lot of people don't realize it can be avoided. It can be avoided. You can do, like, this is one of the reasons that we work with retirees only, people who are around that, that retirement age only exclusively, is because there is so much you can do to protect against potential downturns. There's so much you can do to guard against this with some planning. It doesn't.
Right. And I think people think that their target date funds do that for them.
Right.
That
Right.
they're assuming that because the target date is their retirement date, that they're being taken care of and that fund is creating a retirement plan for them. And there's so many more steps that need to be taken. And really it can be the difference between the retirement you've always thought you were going to have and just an okay retirement, right? It's like I said, it's just being honest. It's not the difference between working until 65 or 90. It's most people, that's not the line that they're straddling. It's the difference between a great retirement and an okay retirement, or the difference between spending what you want and leaving money to the kids, grandkids, or spending what you want and being worried it's going to run out.
Short term, some volatility until we get some comfort in what's going to happen and what's happening. Medium term, we could see some type of big correction over the next couple of years. We don't know if it's going to come this summer or 2 summers from now or 2 years from now. But the market is due for some type of correction. The economy is cyclical. It can go into a recession. Everything kind of cools off. Just been so high and so much growth over the past few years that a correction or a pullback is probably or possibly in the cards over the next couple of years. 10 years, 7 years, 8 years, 10 years, we do see it being higher than it is today. So if you have money that you want, that you're not going to touch for 10 years, let's not touch it. Let's go ahead and invest, because 10 years from now, it's going to be higher than today. We're not going to try to time it. The old saying is, and the thing that I try to remember to, or try to remind folks of is time in the market always beats timing the market. That is, timing it is not going to work along the way, but just having time in it, you'll see it grow over that time. So the bottom line here is for people that don't have 10 years. If you're going to be using your money within the next 10 years, we need to do some planning around that, because you could go to use it in the next 10 years and have it be lower than it is now. That applies to clients who want, more income than they're currently getting, or have some big expense that they're planning on getting. They're planning on getting it out of the market in the next few years. Let's plan for that now, because the market could be lower a few years from now than it is today.
Of course. And from our client's perspective, just to summarize, the mindset that I'm seeing, the whole second half where you're talking about confidence in the market long-term and believing in it, they tune you out. They don't care. The short term is all that matters.
Yeah.
Not in the plan, in the way they're thinking. They don't care about 20, 30 years from now. In their minds, how the market does 20 years from now is for their beneficiaries. That just affects how much the kids get to blow on new cars and pools. The next few years, whether you're approaching retirement or you just entered it, that's the only term they care about today. I'm not saying they don't care about how much the kids get. I'm saying their mindset is built around how is the next 1 to 3 year cycle going to affect me.
Yeah.
And it's all that matters. The short term it's the only term when you're approaching retirement, because working longer is just not how people think about it. They don't want to, the years are too expensive to say, I'm going to go work from, instead of retiring at 62, I'm going to work until 67 because the S&P is down. I don't know how to put a number on it, but every one of those 5 years is expensive. We can't just default to giving up years.
Yeah. Yeah. It's, we don't think about just how long, longevity, how long retirement will be, but we think about how many good years we have, because retirement it comes in 3 phases. The old adage is that there are the early years where you're spending a lot of money. They're the go-go years. And then their middle phase of retirement, they call it the slow-go years. That is, I don't care if you're going on a cruise. My legs hurt. I don't want to go on the cruise. I don't want to sit on a plane.
I'll go on the cruise, but I'm not doing the excursions. That's what I see a lot.
Yes.
Yeah. I'm staying in my room when we park at the dock. Yeah.
Yeah. And it's natural. I mean, I was just talking to a client the other day who was talking about a trip they took. They loved the trip and it was great. But he said, man, that flight, 15 hours to get there. I don't know if I'm gonna be able to do that again. It just gets a point where you're like, this is not worth it. And so your spending goes down a little bit there. And you're slowing down. And then late retirement, it is, you got medical expenses, those things. So retirement, maybe 30 years, but we're looking at the next 10 years being the best 10 years of your life. So let's not delay doing stuff for a few years because the market may be going down, or does go down. Because those are years you're not going to get back. We're not talking about 3 years out of 30. We're talking about 3 years out of 10 really, really good years where you want to do those things.
We're talking about the 3 best years. You have to view it as every year. And this is just from what I'm told by every single person that walks into my office. Every year you feel a little worse than you did the year before, or it takes an extra day to recover from the cold, or your legs hurt for an extra 12 hours after the flight to Europe. Every year is not the difference between I can go or I can't. It's the difference between how fun is it? How badly do I want to go? How much hassle do I have to overcome to go? And it's usually the guys complaining about it while their wives are wanting to travel. So it's, my knees hurt. I'll only go once a year. It's instead of twice, and you see that decline, but it's how many years are you going to be able and willing?
Yeah. Really enjoy it. Go see the grandkids, go take them to Disney World, do the trips, do the RV around the country. These are the years to do it. And we don't want to let the threat of a bad market stop you from doing those things. We've talked about a lot of the problems today.
Yes.
We do planning around all of this. So if you're watching here and you'd like to find out kind of what the plans look like, how we plan for down markets, and put all these things together, come see us. Come to one of our events. We do a case studies talk in our office where we do a sample plan before and after, show you kind of how things move around and the different results of that. So come to that. If you want to see kind of a big picture strategy, come to our Chop House Steakhouse event. We've got something going at Chop House Steakhouse every Wednesday for the next month or two. We're doing that to make sure all the clients can get in that want to get and see that. So we'll do that. We'll do that there, that talk, as long as people want to come to that. And then we'll do the case studies talk just regularly every Thursday in our office. We'll do that for lunch as well. So couple different ways to see what the strategies look like and how we prepare for potential downturns. It's not about just white knuckle this thing, just hang on. No. One of the things that we do when we're younger is we have to just hang, right? You're invested, you got to stay invested. But when you get to retirement, that needs to change a little bit. That mindset of, we'll just stick it out. We're just going to ride this out. You have other options. You have much better options than that.
Of course. And we're not trying to change. I don't want to change the saver from being a saver. What got you to retirement is a great skill. We just have to redirect it a little bit and give you the security that you're looking for.
Yeah. All right. Well, thanks very much for the time today. And we'll do this again. This was fun. We'll do this again.
Of course. Thanks. Yep. Sounds good. Thanks.